Hello and welcome. This is Jason Martin from AllGen Financial Advisors. Today is May 10th, 2022, and wanted to give you a market update with this recent volatility. Has caused a lot of people to be nervous about their accounts and nervous about the market. So let's jump right in. We'll definitely cover kind of what's been going on in the markets year to date, and especially want to cover some of the big bond worries and the worries about the bond market. And then what is AllGen doing to protect the accounts from any further losses? And then kind of touch on some sentiment stuff to show you historically what happens when certain indicators are where they are right now. So let's jump right in. As you can see here on this first slide, this is the year-to-date returns. And I have 5 different indexes up here. You can see from the beginning of the year, the blue line here is bonds. Bonds are down 10.11%, and that's actually the best index. However, that's still down an extremely high amount for bonds. If you look here, these other 3 indexes here in the middle, this makes up kind of the main stock components. So you got the S&P 500, which is the purple one, the S&P 600, which is your small U.S. stocks, identical returns, both down 15.85%. And then you have international and emerging markets down 17.19%. I threw in this last one here, which is the Nasdaq, just to show kind of something that we've been talking about for a while, that we thought growth tech stocks, which is mainly what the Nasdaq is, were extremely overvalued. And as you can see, just year to date, they're down 25%. That's already in a bear market. A bear market is defined by being down 20%. So those large growth areas that we've been talking about that were extremely overvalued have started to come down significantly. And a lot of portfolios that were really overweighted in those areas, which a lot of portfolios were, are really taking a hit. It's not the case with the AllGen portfolios. We've been underweight that, and I'm going to talk about that in a second. So, but also before we kind of get into that, I want to let's look at the last like 3 years, because a big part of how people feel about the market right now and about it being down as much as it is year to date, what happens is when you go through such a good period, and for the most part, other than this drop during the pandemic right here, for the most part, from this point to really kind of over here at the top, the market has had a really good 3-year run. And you can see, the orange line here being the Nasdaq was up about 130%. The purple line being the S&P 500, it was up about 90% at its high. Same thing with small caps. Even international, which hasn't done as great, was up about 25-30% through that period. And bonds were positive. In fact, bonds are still positive over that 3-year period. But right kind of about November of last year, somewhere between November and December of last year, you had a change in the markets, and the markets started going down significantly. At first, the Nasdaq was the one that really took a big hit, and it's been down quite a bit, followed by the S&P small caps, and international has been was the first one to start to decline, kind of around January, February of last year. But I point all this out to say, when markets have such a strong run, people get used to those returns. And markets don't always go straight up. Even though we had a big drop in the pandemic, you can see that happened so quickly that, you had a drop that lasted 1 month, and then, a couple months later, the market had already gotten back to where it came from. But this drop recently, we're going on 4 or 5 months, 6 months in some markets, and really, if you talk about international, a good year, where markets have continuously declined. And because people are so used to markets going up for so long, this has seemed like a large pullback and a very significant pullback, because they haven't been accustomed to drops in a while. And this is something that I've also been talking about, is really from this point, up to here, a lot of those market returns were driven by extreme amounts of stimulus. You had, right after the pandemic, the Federal Reserve printed a lot of money. Central banks around the world printed a lot of money. They dropped interest rates down to zero. They were sending stimulus checks. So a lot of that move was really pumped up by all that money printing. Well, now we've taken away a lot of that stimulus that the Federal Reserve has, central banks around the world have, because inflation got so high, and now they're taking all of that away. And so it's natural to see, some of those markets to come back down. So let me keep going here before we touch much more on the stock market side of things. Let's focus on the bond side of things. So this is not a typo up top here. This has been the worst bond market in 180 years. And this is a Wall Street Journal headline here, but it says it's the worst bond market since 1842. And I like this line right here, and I'll explain it, but that's the good news. And the reason why that's the good news is because obviously we can't go back in time. That's already happened. The bond market has dropped significantly. And so, and this has been the worst bond market in a long time. You can see even right here, this is, if we just look at this box right here showing best and worst time periods. I'm really focusing here on the worst time periods. And this really only goes back 40 years. But since 1980, the worst bond market, worst rolling 12 months is the time period we're in right now. And so it's down 8.51%. The worst 3 months, same thing, the time period we're in right now. The bond market dropped 7.5% during that time. And then the worst 3 years, we're in that right now for bonds. It's been pretty much flat for a 3-year period. So we're experiencing a very difficult time period with bonds. And the reason why that's good news from the standpoint of looking forward is usually when any market, but bonds included, when they take their biggest drops in a certain time period, following that usually becomes some of their biggest returns. If you think about back in 2008 when U.S. stocks dropped, they had a massive drop in 2008. One of their biggest returns was the rebound in 2009. In 2002, the stock market had a big drop. 2003 was a big rebound year. So let me kind of jump ahead and kind of show you that. But really what I want to do is when you think about bonds and who that affects the most, it's really your conservative, your conservative investment portfolios. And so clients that are conservative and even a little bit more balanced, they're being affected by this more than the aggressive and moderately aggressive accounts, because stocks aren't down nearly as bad as they've been down, over the last 50 years, where bonds are down significantly in, like I said, the worst times in 180 years. So let's look at what that looks like from a conservative portfolio. So I'm showing you here our conservative benchmark, and which would be made up of 70%. See right here, 70% of the Barclays. The Bloomberg Barclays U.S. Aggregate Bond, which is like the standardized bond benchmark. It's kind of like the S&P 500 for stocks. It is for bonds. And so the conservative the conservative benchmark is made up of 70% bonds and 30% stocks. All right, and you can see the stock portion, this 30% right here, is a mixture of the S&P 500, large U.S. companies, the S&P 600, which is small U.S. companies, and then the MSCI All Country World Index, which is international emerging markets. This section right here makes up the other 30% of stocks. So that's a conservative benchmark. It's not the AllGen portfolio, although the AllGen portfolio is somewhat close to that. That's just kind of giving you the index and what the benchmark returns are, or excuse me, what the breakdown is. In this next slide here, this is showing you the returns of the conservative benchmark. Again, this is not the AllGen conservative portfolio, but similar returns. I'm just trying to communicate kind of what you can expect historically, or what you have experienced, and what we're currently experiencing with a conservative portfolio in general. So this goes back really to the start of 1996, and it looks at the returns over the last 26 plus years. A conservative portfolio has averaged 6%, conservative benchmark. And you can see, that 2008 time period was a pretty bad period. This time period right here has actually been worse than the 2008 period for conservative portfolios. And so this is looking year by year returns over the last 26 years for a conservative portfolio that's made up of mostly bonds, 70% bonds. So you can see 2008, which is right here, that's down 9.33%. Look at this calendar year, and this is actually just through April. It's down 10.35%. So this year, conservative portfolios are down worse than they were in 2008. And back to what that Wall Street Journal article is showing, that's the good news. And it's not good news if you're invested in the portfolio up to this point. I'm not trying to make light of it, But what the point I'm trying to make is that's already happened. Now going forward, what typically happens after a really bad time in a conservative portfolio, or like I said, in any market? So if you look here in 2008, what was the year following 2008? Well, the market actually the conservative benchmark was up 13.84%. And in 2018, there was a small negative return, but that was the only other negative return. There's 3 negative returns in the last 26 years for a conservative portfolio. One of them was 2008, another one was 2018, and then 2022. Well, after the last drop in 2018, you can see here that the conservative portfolio went up 13.91%. So even if a conservative portfolio was to get back to where it started at the beginning of this year, it would be approximately about 11% return, a little bit more than that, 11% return, just to get back to where it started. And even if it took it 2 years to get back to where it started, that would still be an average of a 5.5% return in a conservative portfolio. And so again, this is after, this part of this portfolio is made up of mostly bonds, about 70% bonds. And this is and we just experienced the worst time period in 26 years. So there's no guarantee, obviously, in markets, but historically, when you've had big drops, you get a good rebound going forward. And so that's kind of the point I'm trying to make by showing you how bad it's been for bonds. But typically, when markets are really bad, what follows over the next year is usually pretty good. So, all right. So, what are we doing to kind of mitigate losses or protect accounts from losses? Well, one big thing that we've been doing over the last couple of years, and especially over the last year, is we've been shifting out of being a little bit overweighted in U.S. growth to going more overweight value. And the big reason for that is we were noticing a change where, over really since 2007, you can see when this line is going down, it's showing that growth stocks are outperforming. Growth stocks being like your Googles and your Microsoft and your Apples and your Teslas, stocks that are growing at a much faster rate, but have much higher valuations. Whereas value stocks typically have much cheaper valuations, like their price compared to their earnings, price compared to their book value, or price compared to their revenues, are at a much better valuation. Sometimes they aren't growing as fast, but they trade at a cheaper value, a cheaper price. And so you go through kind of these long-term time periods where value will really outperform well, which is what happened from really kind of this 2000 all the way to 2007. Value significantly outperformed growth, but really over the last 14 years, growth has outperformed value. But as you can see at this green arrow, we've recently broken out from 2 kind of significant trend breaks. You have this downward trend line right here, this resistance line that it broke over here. And then you have this base that's built in technical analysis called a double bottom. And it's confirmed when it breaks above this high, which it recently did. So it's showing that now value stocks have started to outperform, and potentially the trend has changed now where they're consistently going forward start to outperform. And there's been bad times in the market where, like 2000 to 2002, for example, the S&P 500 was down about 40 to 50% during that time period, but value stocks were actually flat to even positive. So you can have really bad markets, but have pockets of the market that can do well. And so that's what we're seeing with value stocks. And I'll show you kind of what that looks like here. So this is just year to date. You can see growth stocks are the purple line. Value stocks are this orange line here. And so this is just kind of an index. It's really an exchange traded fund that replicates the Russell 1000 growth and the Russell 1000 value. So you can see that the difference in returns this year. Now we use a different value fund that's actually held up better than even this value fund, but we have shifted out of growth. In fact, we hold very small amount of growth, and we've gone more into overweighting value. And we even started that process last year. We continue to do it this year. So that's one thing that we've done to help protect accounts. And again, a lot of people have gotten really used to some of the technology stocks that did so well, the Nvidias and the Facebooks and the Netflixes and the Teslas and the Apples and the Amazons that have done so well over the last 10 years, that their portfolios became very overweight in those areas. And this year, some of those stocks are down over 50%, and a couple of them even down over 70%. So, but as a whole, growth stocks are down significantly. By us not holding as much growth, it has prevented some losses and helped us hold up better in that area of the portfolio. Another thing that we've done coming into this year, and even really going back to 2020, late 2019, early 2020, we started getting into gold, and then we've been into commodities even as we went into 2021. And so this is just looking year to date. The purple line is commodities, and the orange line here is gold. And even though gold hasn't had a significant return, we haven't really been overweight gold. We just started adding back into it recently for precautionary reasons. And if we continue to have extended kind of extended inflation that keeps lasting longer, then gold should hold up better than other asset classes and potentially even go up. So this is something that we held to protect the accounts. As when inflation comes, these are areas that typically do well. Now, the other thing that I want to point out here, as I kind of wrap up everything, is that the sentiment right now, meaning people's feelings about the market, is extremely negative. It's very pessimistic, and so what we're looking at here is what's called the dumb money confidence. And this is not meant to be condescending in any way. This is something that's tracked by an organization called the Sentiment Trader. And the theory behind it is the average investor is usually wrong. They typically buy when things are high and sell when things are low. And so there's been studies like this. Dalbar has put out a study that shows the average investor has significantly less returns than just investing in an index over time. And it's because they are persuaded or they're motivated by their emotions. And when things are great and markets are going up, they like to buy. When things are bad and things are going down, they tend to sell. But in Wall Street, or I often talk about this phrase that Warren Buffett said. That is when in Wall Street, when everything goes on sale, it's the only place where people, where when everything goes on sale, people run for the exits. But typically, when everything goes on sale, you need to be getting into it, and that's when you should buy. And it's so this indicator, if you look here, this line is marking what the feelings of the average investor, what they call dumb money. And when this line gets low, the dumb money is extremely pessimistic, okay? And they don't think the market's going to go up. And so historically, when the dumb money has been this pessimistic, markets have tended to rebound significantly following. So if you can see down here, anytime when this indicator has gotten as extreme as it is right now over the last over the next 2 months, 3 months, 6 months, and 1 year, well, from the next 2 months, 3 months, and 6 months, 93% of the time the market's positive, and it's had big returns. And these aren't annualized returns. So 10% over the next 2 months, 16% over the next 3 months, 22% over the next 6 months, and then 87% of the time over the next 1 year. On average, it's up 34%. So again, this is just one sentiment indicator, but I could also show you other ones like the Volatility Index, like the AAII, the American Accredited Individual Investors, which also show very similar extreme pessimistic feelings, and their returns over the long run tend to be much better after they're extremely pessimistic. There's no guarantee that the markets will go up from here, but we try to use probabilities as a guide, and the probabilities are high that the market will bounce. And even this is looking more at the stock market. This is the S&P 500 up top here, but we also believe the bond market will bounce. So in summary, going into this year, we were very underweight bonds. So as bonds went down a lot this year, even though we held bonds, we didn't hold as much as you normally would hold bonds in each of our different risk profiles. So now that bonds have gone down significantly, we just recently started adding back into bonds because, as we mentioned, bonds have had one of the worst times in a long, long time. And so usually after the worst times come better times. Well, remember also we owned commodities going into this year and some gold, and we've even added gold recently for precautionary reasons in case inflation continues at these high levels. And then we've reduced growth stocks and added to value stocks, as value stocks were very undervalued compared to growth stocks and should and historically have outperformed when that's the case. So those are the moves that we've been making to really protect our client accounts, and those are our thoughts on the market. Also, remember, our job, and we take it very seriously, and our philosophy is we always want to manage risk first, always trying to protect on the downside, and then try to outperform over the long run, net of fees. To our clients' respective benchmarks. That's the goal. It's a very difficult game sometimes to predict the future, which is what we're trying to do. We're trying to anticipate what's going to happen in the future and position the portfolios accordingly. And so we're trying our best. We take it very seriously, and we're monitoring it on a daily basis. So I hope this helps. Hope everyone feels better about this. If you're still nervous and you're still concerned, please feel free to call your advisor, and they'll walk you through your specific portfolio. So again, I hope this helps, and thank you. Take care.